right, so we're looking at the three forces behind market movements. The name of my company is 3V Trading. The reason it's called 3V Trading is the three V's are volume, volatility, and vibration. These three V's are the forces behind the market movements. And this is, at least in my opinion, the order of the framework in which to consider price action, to consider moves that take place. It's logical. It's based upon experience, observation, and of course, using tools to measure these things in real time and then trade by that every day. So the first one here and the most important one in my mind is volume. And so let's just talk about the beginning of a price move. So price will move when there are orders that are taking place. And so orders create volume, and volume is basically a measure of the amount of orders that are happening at a price level. So for the markets to move, buyers have to come in, institutions have to come in and make purchases. So step one is volume has to take place at a certain price level or a zone of price levels so that there can be an accumulation or distribution period. The next thing that's going to take place is that a certain amount of volatility is going to build because of the volume. And this is kind of, chicken versus egg, which one came first concept. Really, volume and volatility can be looked at, one of those two ways. Now, I see it as it's always volume and volatility. And the reason being, let's just consider sentiment news, for example. Somebody comes out like the president and says, hey, we're going to announce tariffs on a country. Well, when they do that, what happens? People freak out or they move. All of a sudden, some buying takes place into the market, some selling takes place. That creates a volume of orders. If that is a significant volume of orders that really has no direction to it, it's going to build this thing called volatility. So most often we can see volatility quite clearly during news events and sentiment events that take place. Whether that's a non-farm payrolls report, that's some type of Fed minutes or an interest rate decision that's going to go forward. That's going to produce volume of activity, some repositioning in the market, especially for the larger institutions. They're going to be positioning, and when they position, depending on how much volume of activity goes in there, that is going to create more volatility. Ultimately, that undisputedly that's going to lead to number three, which is vibration. And vibration, by what I mean by that is it's just price action, that you're going to have an up and down movement, a vibration that takes place. And then you're going to see that on the chart as in the form of some type of wave, whether it's an up wave and an uptrend, down wave and a downtrend. But you're going to see, some type of price action develop. That's going to come from institutions coming in at volume. They create some volatility, and then once they've created the positioning that they want, they're going to begin to move the market. That's ultimately the vibration. This is often talked about in smart money concepts, which is, like the last 7 years in trading, I believe, where we've seen inner circle trader, ICT concepts. They have the AMD model, which is accumulation, manipulation, and distribution. And so, really, what that is it's basically these three forces in a final form, because we have volume that begins accumulation, that picks up some volatility, which is then used to manipulate the market, and finally it ends up in a price move, which is the vibration that takes place. So literally AMD, volume, volatility, and vibration. Very similar concepts. I like this one for myself just because, hey, I made it. Number two is that to me this underpins a universality that can be seen behind all of the markets and exactly how price action works. So we're going to cover today just a brief look at a volume tool and how you can use that volume tool to trade, and inside of this framework of 3V framework of how the market is going to move. So I have Addis pulled up, which is one of my trading platforms. I trade with Addis and with NinjaTrader. But Addis has some of the best volume tools in the business. Not saying you can get them elsewhere. NinjaTrader, you can add them in, or you can buy the subscriptions for them, or you can go out to somebody like TraderDale and pick them up. But on here, I'm looking at the NQ. I only trade NQ. I'm looking at NQ 30-minute chart, and in the NQ 30-minute chart, what I have is I have a volume profile. And this is a unique volume profile because this volume profile is only for the RTH, which is the regular trading hours. You can adjust in Addis whether you want to see ETH, which is the the ETH is the electronic trading hours. That's all of the trading hours, or RTH, which RTH is just the regular trading hours. Regular trading hours, those are going to go from 9:30 open until 4:15. So most of the instruments that are going to be covered under the regular stock exchange, or the NASDAQ stock exchange, in this case we're talking NQ, are going to be in those regular trading hours. Now what you see in front of you is you see basically a day. They're separated by these blue lines, and then you're seeing the first 4 hours, including a 1.5 hour pre-market for each session. So this is Asian session in red, this is the Euro session in green, and then we have the US session in yellow. And you'll notice that the volume profile picks up here at the 9:30 mark, and then it's going to stop right at 4:15. The volume profile taps out. So right here at 4:15, this volume profile is over with. A volume profile, basically what that does is it gives you the trading for every price level, the trading volume amounts that were transacted. So you see very little was transacted down here. A lot was transacted here. This has a certain shape to it. This is called the P shape for this particular day. I think we're looking at, what is this, the 11th. So July 11th, we're looking at that. But how do we use this? How do we make decisions based off of volume and volume profile? So go back to what we're talking about, forces behind the market. There's 3 forces: volume, volatility, and vibration. Volume, like I said, is the most important one, or I believe is the most important one, because it kind of creates the other 2. So if you look here at this volume profile, what you'll see is there's 3 points on the volume profile. It's a little bit clearer on this one. There's a VAL, a VA, and a VPOC. This is a value area high, a value area low, and this is the volume point of control. And the volume point of control, what that is, that's where the most volume was transacted. So the most volume was transacted right here. The volume area high and the volume area low represent the area normally in these type of profiles where 70% of the volume is transacted. Now I have a little speciality that I do with my Addis and my volume profiles, where I want to make sure that I am playing to the 80% versus the 70%. So I adjust. You can set it up in Addis to adjust to the 80% value area. So the value area, again, that's where 80% of all the volume is transacted. For me, on most volume profiles, that's going to be 70%. So I've just set that setting because it's customizable in Addis, and I'll explain in a moment why I do that. It just creates a better chance of you making sure that you're going to get your price level. So we're going to go into today, and this was a great trading day for me. To come here and review how this works and what is the science behind it, and I'll talk about some other trading groups. Ideas, they don't come out of a box. Ideas come out of one person, 2 people, group of people, and then they disseminate that idea, and you never know who had the original idea. But there's a basic premise between about these volume profiles that, as you know, this only does, again, regular trading hours. So this is the bulk of all trades transact on the US session. So for NASDAQ, all of these trades between 9:30 and 4:15, that is the bulk of the trading activity, because the most of the US institutions are the ones buying and selling stocks that are NASDAQ stocks. So when we look at this, what happens is after the market closed, obviously it gapped down into today, and so there's this gap between where we left off and where we open. This is the futures market, so this is a 5 o'clock close and not the regular 4 o'clock close. This is a 5 o'clock close, and then here's the open was down here. This was from a Monday to a Friday, so we call that an NWOG, new week opening gap. It means that we opened up for the week below Friday's price action. And so what it does effectively when this happens is it leaves, and this happens day to day too. Some from day to day, you may open up at a different level than what you closed at. And you can't really see that on this chart because this is futures, but I can give an example. When the market opened, it was actually, see, 9:30, it's right here. So the market was actually right here, but it closed the day before. The 4 o'clock close was 4 o'clock close was right here. So here the market closed at 4 o'clock, and then when it opened up, it was down here. And you'll notice what the market did. It came back up to it. And so this is a very important volume concept of what's happening. Basically, institutions are left on the hook on the overnight. Most institutions are not trading past their algorithms. They're not trading in the overnight, maintaining all of these positions, again, past algorithmic trading. They're not maintaining all of these positions, and so they have a risk when they get in the next day and the position, or the next week, and the position's opened up below them. So I'm going to go back over here. The position's opened up below them. They have to get the opportunity to get out of the market. This creates a gap. And one of the best plays that you can make in the U.S. session morning or the U.S. pre-market is to either take the gap back to where it gapped from. A lot of times you'll have a gap, you'll come up to it, and then you'll start to collapse off the gap. We did that today. We collapsed off the gap, and then we found support and started to move back on. And so when you see these type of things take place in the market, you have to realize that large institutions were on the hook. They had significant volumes, and where were they at? Well, they were at this volume point of control, and 80% of all of Friday's actions was done inside of this place. So how do we use that? How do we use that to trade with? This is a really simple feature on a chart that we can look at, but now we can see that when the market is moving back up at least to the value area low, if it gap down below it, then that gives traders or institutions a chance to get out of their positions. Now, there is, based on convergent trading, this is something that comes from Futures Trader 71. You can check them out on YouTube. Convergent Trader. They have a great course in there, study, mentorship, all those things. But they basically say that 80 to 85% of the time, when you open up, then from one day to the next, you're going to come back up and you're going to touch that volume point of control. And the reason that this concept is important is because you're coming back to the areas where there was the most market participation. So volume profiling, order flow, and footprint charts, they talk about an auction environment, which is where the market is agreeing on what is the right price. And this is where the most agreement was. Now, I don't necessarily use these levels as a hardcore support or resistance, but as an area where price goes to there, it's what they call imbalance. So from Futures Trader 71 and convergent trading, what's going to happen day to day is 80 to 85% of the time, wherever the market opens up, it's going to come back and it's going to touch the prior day's volume point of control. At least price is going to reach it. Now, from my own studies, I'm going to say more than 90% of the time, we're going to come back and at least touch the value area low or the value area high. If we gapped up here, we're going to come down and we're going to find support on it. We could probably find one of those too that just barely touch it. Let's see. Maybe. Yeah, so here's one. So you can see that the market was already way up. This is the European session. It was way up, and this is in the pre-market. So what is happening? Here's that value area high from the former day. The price is going to come down and touch it. It actually got down to the volume point of control, and then it moved on. Why does this happen? Why is this a highly predictable trade? And it's based around coming back and what it's called is balancing the prior VPOC, balancing the prior VPOC, or at least balancing the volume point, the value area high or value area low. The reason that this happens, again, is because these large institutions are on the hook. They got taken up overnight. They have got, if they had whatever shorts they had, they have to get out of them. So when this comes back to this area, this is a fair price for them to exit their positions. If they were in a sell at that time, they were losing, what they're going to do is place a buy order to close their position out. And then that's going to drive the market higher because now they're all buyers. So these institutions, the most volume are right here. They might have been thinking, some of them, that they were going to see the market go lower. It didn't. It went up overnight, came back in the morning, gave them a chance to get out flat. And to get out flat, they had to buy. And then that sent this up even higher. So this is the volume point of control, and the value area, which is defined between the value area high and the value area low, along with the overnight gap and the new week opening gap. Those are places that the market is highly probable to go back to. These trades are going to put you, this framework alone, without us going into anything else, is going to put you on the right side of the market for your pre-market morning, for U.S. session, our late European session, which is 5:30, into the U.S. pre-market, which officially begins at 8. This is going to put you into that little area gap and into this early U.S. pre-market, 80-90% shot that you're going to go back to that level. That doesn't mean that the market won't continue to go in the wrong direction for a while, but it does mean that there's a high probability that you're going to go back to at least touch either the high or low, depending on if you're below it or above it, or the volume point of control. And so, how did this play out in my trade this morning? So what I was doing this morning is I seen this volume area low right here, and this is what I was originally targeting on the way up. Now, I got chopped out of this trade right here when I was sleeping for a loss, and then scalped this on the way back up, got it into here, and then once I was here, it moved up. So this was the gate at 9:30, and it doesn't look like much on this chart, but we'll see it on the other chart in a second. I use a 72-second chart to look at my entry time frame, so just slightly over 60 seconds, so just a little bit more than a minute. We're 12 seconds more than a minute on the 72-second chart. But you can look here and you can see that we went up, and what did we touch? We touched the volume point of control, and then from there we proceeded to collapse. So let's look at this in a lower time frame. I'm going to move this chart off, and let's talk about this trade on the morning. Adjust this one. All right, so we don't have the volume point of control up, but this is the level the volume point of control was at. And I'm pulling this off. You can't see both my monitors. I'm pulling this directly off the 30-minute chart. It was at 975. I'm just going to put a horizontal line here so that we can see that. So we've got that. Let's get this out the way. All right, 975. All right, so case in point on how this works. And this situation, this is like a perfect storm. So here's the market moving up, up here to the 975. This is the volume point of control from Friday. The value area low was right here at 945. So when we opened up this morning, we went back into this value area low from Friday, and then we moved up to the volume point of control. And again, the volume point of control is where we had the most participation, the most buying and selling, the most orders took place at that volume point of control. So you see we came up right after the gate and we touched it. What this effectively was it was a gap fill. So This filled the gap that existed from the week. So from one week to another, on Sunday we had the Trump tariff news on the EU, Mexico, and Canada, and so we opened up lower, and then all of those institutions were on the hook. So if they were long at the time, they were all on the hook. So it came over here, and they had the opportunity to get out flat. And what do? It comes up. I put in my short right up in here, comes up and just craters, begins to fall. And at the time, all of the volume that was built up, and it changed as the day went out. But at that particular time, most of the volume was down here, and so this was where the traders from uh, the overnight were at. This is where they had entered the market. So it came up to the volume point of control, and then fell down to what was the current volume point of control for the U.S. session. But the important thing here is that this is a highly probable trading environment where you're going to come up and touch or balance. That's what they call it in many circles. You're going to balance the prior days or prior weeks volume, last day of trading, prior day volume point of control, and then the people who were long, the institutions who were long, they were getting out of their orders. So if they were in buys and they were underwater, when they came back up here to this point, then they needed to close that position out. So if you're in a buy, what are you doing? You're going to close it out with a sell. So they closed it out with a sell, and it drove the market down. And this happens pretty much every day. It's not always to the same degree, but this happens pretty much every day. There's some form of rebalancing in the market, and you're usually going to balance either the 80% between the value in the value area, between the value area high and the value area low, or you're going to balance the VPOC. And in strong trending markets, you may not come back to the VPOC. You may only get the value area high. We saw that back here where we had a very high trending market. It did actually come down to get the VPOC, but it didn't move very much. It just came here and right above. Normally you're going to see a balance take place though. And because this is 80% of the value area, the probability that you come back and touch this is extremely high. So this just viewpoint, let's break it down just real simple. If somebody told you this very early on in your trading, it could put you on the right side of the market, put you in the right mind frame to make money and have the probabilities working for you right out the beginning. If somebody told you, hey, all of the institutions on Friday, 80% of their volumes were transacted up here. All of their positions are up here. So if they have buy orders, those longs are up here. When the market opened up down below it, those institutions were on the hook and losing money if they were not hedged on those positions. So what did they want to do? They want to spend a little bit more money. They want to drive the market up, and then they want to get out. And that's what creates those opportunities that took place. Now, after this balance, then they continue to move on. Just because you have this initial bias based on volume balancing the prior VPOC or the value areas high or low, it doesn't mean that's how it's going to play out for the whole day. It does mean that you're likely to get this highly probable response to it. So in this case, you're going to get the thrust, and then once it gets to a place they can get out flat, because they have to initiate sell orders to get rid of their longs, then it's going to drop below. All right, so we discussed again forces behind the market movements. Here I simply discussed volume and only discussed the volume profile. We'd not go into order flow or footprint charts. Those are more advanced things. Here we're simply looking at, when we sit down in the mornings, step one, what do? We're going to be looking at the prior day volume, or the prior, if it's a Monday, we're going to be looking at the prior Friday's volume, the value area high, value area low, and where the most volume, or the VPOC, is at. Then we're going to see if there's a high probability trade where we're going to go back to that and how much room that we have to get to it. Once it hits that area, then there may be additional opportunities, especially if there were a lot of underwater on the hook orders. Like these longs here were on the hook, and then this allowed this, very large fallout to ensue. And if you look at the points here, this was 977. It's over 100 points. So it's about 120 points, and this covered that 120 points. It's 931, 943. It was in less than 15 minutes. And you could have anticipated this move simply by understanding how the volume was positioned for the institutions from Friday going into the beginning of the week. All right, so that's going to conclude this one. I wanted to keep it as short as possible, but give a lot of presentation and understanding of volume profile, and especially how that applies to volume and how that is one of the forces behind market movements. Hope you enjoyed it. Happy trading.